Well, thank you so much to the organizers. This has been a fantastic day, and I'll try my best not to bring down the average too much. This is joint work with Agustin on the role of minority depository institutions on closing the access to credit gap that we see in the United States. Usual caveat, I'm at the Chicago Fed, so these views are ours only and not those of the Fed, or the state bank supervisors who provided us with some cool data. So there's significant interest in promoting minority bank ownership that's increasing recently with light being shed on racial wealth gaps. And these interests come from regulators, corporations, and governments alike. Give you an example, the latest Biden-Harris administration announced over $8 billion of investments into community development financial institutions and MDIs to promote closing wealth gap, among other reasons. But despite this interest, we know very little about the actual effect of these minority banks on closing the credit access gap. So in this paper, we're going to try to answer a couple questions related to that. One, do minority bank ownership actually expand access to credit to minority households? And second, if so, what is the economic mechanism that drives this observed effect? And what allows us to answer these questions is a data nexus where we link information on the three primary actors. One, the bank, the lenders themselves and their identity. Two, the borrowers, their demographics, but also their risk characteristics. And three, the loan officers who work at these institutions giving out and making the actual lending decisions. Let me begin with some definitions first. So for racial minority groups, we're going to work with non-Hispanic Asian, Black, non-Hispanic Black, and Hispanic categories from the OMB Directive 15. Now, these are very broad categories, and of course, there's a lot of heterogeneity even within these racial minority groups. But these sort of categories allow us a very consistent definition of racial groups that we can port across the different data sets that we combine. The other interesting category are Native Americans, but we exclude them because one, a small sample size, and two, they're governed by very different laws and they're in very different geographies. In terms of minority banks, the different regulators in the US, so the Federal Reserve System, OCC, FDIC, they define minority banks differently. But in this paper, we're going to work with a 51% threshold based on ownership only. So if more than 51% of the bank is owned by minorities, it's going to be classified as a minority bank. The other two definitions are based on board composition and the markets that they serve, which are also interesting. We're not going to be able to talk about those today. And then, of course, there are also multiracial and female-owned banks, which are very, very interesting topics related to gender gaps. But again, we're not going to be able to talk about them today. Just to highlight that the data combination was not a trivial exercise, to highlight a couple things. We had to make multiple Freedom of Information Act requests to these regulators to get the data information on identities of MDIs and whatnot, and also their board composition. We also have to use facial recognition on the profile pictures of loan officers to categorize them into racial categories. To describe the data sets a bit more broadly, there's two data sets that span a long time period. One based on the bank identity, in particular their minority ownership, and a bank ID that can be linked to other data sets. And we got this from multiple FOIA memberships, from other data sources. We have information about the borrowers, loan characteristics, demographics, their not precise, but somehow disaggregated location from the public HMDA, which is the largest mortgage data that we use in the States. To these, we add two other data sets that are, in some sense, a bit newer. One is detailed credit risk information, including credit scores on these borrowers, and this is available from the confidential version of the HMDA, available from the board. And this is only 2018 and after. And then we have information on the loan officers, their loan officer IDs, as well as race and ethnicity information we can infer. That's also more from the more recent data from the state supervisors. Now, I want to first describe the ideal thought experiment. So suppose we have two Asian borrowers, and we want to assign them randomly, one to an Asian bank and the other person to a regular bank, and see what happens to their mortgage application. Are they approved or are they denied? In reality, we don't have that ideal experiment, so we're going to try to approximate that in our observational design by using a fixed effect strategy, comparing two Asian borrowers again, going to one Asian bank, one regular bank of similar size. They're going to apply for mortgages with very similar characteristics, They're going to have same demographic characteristics, and we're going to include location and year fixed effects to control for economic conditions. So you can see the equation up there. Now, even that fixed effects specification, of course, has a lot of issues. The main one being a non-random matching between the type of the borrower that's going to go to an Asian bank versus a regular bank. There's two types of selection issues. One is based on selection on observables. For example, maybe more credit-worthy Asian borrowers are sort of look out for these Asian banks and go to those things. The other is an independent effect of the loan officer. So we have some recent evidence saying that when an Asian borrower goes to an Asian loan officer, they're more likely to be approved a mortgage. And then, of course, Asian banks are more likely to contain Asian loan officers versus other banks. The second is selection on observables, which we're going to address with the Oster's delta test. I'm not going to talk about that today in the talk, but it's in the paper. Our approach is to overcome these issues by bringing in the two data sources that I mentioned before. One, we need to create an accurate information on the loan officers' racial identities. And here, because we're using these as controls, measurement error really matters. So we have to be really accurate about identifying these loan officers, what racial groups they belong to. So we have two algorithms. One, which other people have used based on the confidential state bank supervisors' data. We use the locations and the names of the loan officers to categorize their race. But especially when it comes to white and black names, which are very, of course, in particular, they share very similar last names, this is not the most informative. So we also bring in data from multiple data sources, including LinkedIn, which might be the most familiar to you guys, get their the headshot, and use a facial attribute recognition to classify them into racial categories. So to sort of refine the study design, we're going to have a fixed effect strategy, again, comparing two borrowers, one going to Asian bank, one going to non-Asian bank. But now it's going to be with the same loan officer race and with the same credit risk as measured by the credit score. And this is one of the first results. So what I'm plotting for you here is a gap in approval rate between going to an Asian bank versus non-Asian bank. And what this says is that for an Asian borrower, going to an Asian bank versus a regular bank, they're about 6 percentage points more likely to be approved a mortgage. And this is larger, even though standard errors are quite large, than the Asian officer effect. So by going to an Asian officer as opposed to a white officer, they're about 2 percentage points more likely to be approved a mortgage. Similar pictures emerge for other racial groups. So for black borrowers, again, the standard errors for the black borrowers going to black MDIs is very large because there's just so few of black MDIs and black borrowers in the mortgage market. But again, consistent pattern where the coefficient of going to a black bank improves their approval odds much more, and then especially in relation to going to a black loan officer. And then likely same story for Hispanic borrowers. And there, the actual difference between the bank effect and the officer effect is meaningful. Now, even with the refined controls, there's multiple issues with the comparisons that I just showed you. One, including the non-random matching. But the other is when these Asian banks attract Asian borrowers, are they just taking borrowers from white banks, not white banks, non-minority banks, regular banks, or are they actually expanding credit to borrowers who otherwise would not be granted mortgage? Are they just cream skimming, basically? And we're going to try to address that by looking at a bank failure, which we think is driven by an exogenous event, and see if that actually impacts credit access for the target minority groups. The natural experiment we're going to use is based on this bank, Abacus Bank, which is a Chinese-American bank based in the New York, New Jersey area. This was actually the only bank that was prosecuted by the government during the 2008 crisis, which is surprising given a lot of banks might have been engaging in suspicious behavior. And there was a documentary based on it, which was nominated for an Oscar, so I highly recommend you guys watch that. So why this experiment is very nice is that this was not a systematic failure. The failure of the bank, or the quote-unquote failure of the bank, was motivated by a bad Apple problem. There was a particular employee at the bank, Ken Yu, who was requesting bribes from customers without the management knowing it, supposedly. And when the management, the Sung sisters, found out about that, they fired Yu, and they launched internal investigations, and they themselves reported this to the authorities. But this being 2010, the Manhattan DA office launched a lot of investigations into this issue, and the response was largely considered disproportionate to the amount of sort of crime that was actually committed. And if you look at the actual mortgage originations by Abacus Bank in red compared to other Asian banks excluding Abacus, we see that up until 2009 there are similar origination patterns, very similar pre-trends, but lending at this Abacus Bank collapses when these investigations are launched. So what we want to do is we want to compare Asian borrowers. Those Asian borrowers in tracks that had previous access to Abacus Bank, and the other Asian borrowers that had access to other Asian banks other than Abacus. And we want to basically see, did Asians who otherwise would have gone to Abacus be denied mortgages on net? So I won't go through the details of the specification. I will also skip this. It's basically arguing that this was an unanticipated event, the total collapsing of lending by Abacus, and so on and so forth. So if we look at the gap in approval from areas that were likely to go to Abacus versus areas that were not, we see that the lending to Asians totally collapsed by 20 percentage points following this investigation. And the timing sort of overlaps with the time period of the investigations. Oh, and for an important detail. So in 2015, the bank was actually acquitted of all charges. So it's more likely that the bank itself was not engaged in fraudulent activity. But in any case, because lending collapsed from Abacus, Asians who otherwise would have gone to Abacus were were not given mortgages, period. They weren't able to reallocate to other banks. If we look at the other racial groups, for Black, for Hispanic, for white households, we do not see the same effect. So what this shows is that likely these MDIs actually expand access to credit and are not simply stealing customers from regular banks. We have some additional results in the paper about what might be driving this. Let me just say that we think it's likely that it's driven by information channel. So Asian banks have better information about Asian borrowers, and therefore they're able to sort of really make better choices for which risk to take on and whatnot. So in this paper, I wasn't able to tell you the second part of the paper. At least we're able to show you that minority depository institutions and minority ownership of the banks can expand credit to minority households. And we are pursuing additional follow-up studies to look at what factors might be making these organizational factors so much more powerful than individual factors for expanding credit to minorities. Is it governance? Is it labor contracts? Is it incentive contracts, management, so on and so forth. Thank you so much, and I look forward to Seula's discussion.
Now we have Seula Kim's going to discuss the paper for us.
Okay, so thank you so much for inviting me to discuss this fantastic paper, and thank you to the organizers for putting this all together to make this session work out. So just to briefly summarize the paper, this paper answers the following question about whether minority bank ownership matters for the minority credit access, and if so, how and why. And the authors tried to answer this question first by constructing a very rich set of data linking banks, borrowers, as well as employees' information by using the following variety of data sources, putting together from the government agencies, federal results, as well as private information from social medias. And then they did so by using uniform or unified bank identifiers, which is very unique in this paper, and thus obtaining detailed bank employee and borrower information. And then relying on this data source, the authors use fixed effects as well as definitive designs to identify the main empirical results. And here's the overview of main findings, which can be characterized by the following four. First, the authors document general stylized facts about minority-owned banks. This bank seems to be specialized in same-race mortgage lending and also has a high fraction of same-race employees as well as borrowers. And then the second thing is about, indeed, this minority bank ownership has affected minority borrowers by increasing credit access, which is equivalent to 10 percentage points in terms of approval rates as opposed to other races. And this set of results are robust to really different mixture of controls that others have investigated. And interestingly, this effect does not hold strongly from the effect of the race of individual loan officers. And the third thing is that this effect of minority bank ownership actually reflects a credit expansion as opposed to credit reallocation, as we found from the findings after the Abacus demise. And lastly, the authors tell us a potential mechanism to understand this, which is information asymmetry channel. And this can be supported by the finding showing that the default rate of minority bank same race borrowers has been indeed lower than other races. And this can be indicative of the minority bank's better information about minority borrowers. So in a nutshell, I think this is super interesting paper and extremely well written. So I enjoyed reading this a lot and learning a lot as well. And I can see that authors really thoroughly investigate the extent to which minority bank ownership impacts minority borrowers. And I can see a lot of immense and pioneering efforts in constructing this rich micro-level data set which have never existed before. And also, the authors have been very meticulous in designing the empirical strategy to identify the main results. And obviously, this is an important question, delivering very important policy implications. And I would like to add the following 3 comments to this paper. The first thing is about the impact on the welfare of minority borrowers. So the main finding of this paper shows that minority bank ownership indeed increased credit access as well as lowers the default rate associated with these credits. But how important it is indeed for the financial well-being or welfare for minority borrowers? So I thought to understand this question, answering the following questions might be helpful. For instance, how much fraction does this credit access account for the minority borrower's credit? So maybe it might be a very small fraction of the minority credits, and if that's the case, even though they have increased the credit access, it might not be very influential. And then also, I wonder, upon approval, does it indeed reduce the credit cost associated with this increased credit access? So authors might be able to see this by just replacing the dependent variable with the interest rates. And then also, does it increase the discrimination against minority borrowers, which is really prevalent, as shown in the previous studies? And to see this, the authors can pull all the borrowers and see the gaps in terms of approval rates or interest rate between minority race borrowers as opposed to other races, and then see how that can be dampened by the credit provided by the same race bank ownership. And then the last thing is about, it seems to me that this minority-owned ownership banks and the minority borrowers have a really tight relationship based on their findings. And if that's the case, it might not be always beneficial in the following sense, because such tight relationship can be able to magnify or exacerbate economic shocks to minority borrowers. So for instance, previous studies have shown that minority-owned banks tend to be hit hard during the economic crisis. And if that's the case, through this tight linkage associated with the minority ownership bank, minority borrowers could be more vulnerable to economic shocks at both aggregate level or bank specific. So maybe adding some discussion to those questions might further help us understand how minority-owned banks impacts the well-being of the minority borrowers. And the second thing is about the direct evidence or testing the information channel. So one potential mechanism the authors claim is about the reduced information asymmetry driven by minority bank ownership. And that could be inferred by the reduced default rate associated with the credits provided by the same race, provided by the minority bank ownership. However, there could be still limitations in the current analysis because it is only evidenced for the Asian banks, and that is mainly due to the limited observation for other races, and also the time period, which was specific to 2018 through 2019. And there could also be alternative hypotheses that can account for these results. One could be that it might be due to the strategic choice of minority borrowers to intentionally lower their default rates in order to retain their reputation or access community capital from the minority ownership bank. So still maybe providing direct evidence supporting this information mechanism would further support this channel. And then one way to do so is to provide direct estimation of the degree of private information associated with the same race banks. And for instance, some studies like Darmoni 2020 and Journal of Finance has documented some ways to estimate the private versus public information using the renewal or recreation of bank relationship after bank crisis. So Darmoni 2020 has documented really sophisticated way to identify the degree of the private information shared with banks borrowers have previously associated with by using two-stage discrete choice model. So they basically control for the selection of stayers after a bank shock and they estimate the propensity of new relationships on previous lenders' crisis exposure to identify the degree of the private information shared with them. So maybe the authors can apply this identification for minority borrowers switching to a different race bank from the same race bank after a certain bank shock. And in that case, the authors can identify and also quantify the information frictions for the minority-owned banks borrowers. And lastly, maybe providing certain general sorting patterns between minority-owned banks and the types of borrowers might also be useful to understand whether there exists certain information friction channel or not. Because if there's some more information shared amongst the minority-owned banks, then the types of borrowers might be really different. They could have more better types of minority borrowers because they have more information about them. So there could be some sorting patterns we can observe from the data. Lastly, really briefly, so I thought one of the interesting contributions here is the distinct role of the minority bank ownership as opposed to individual agents' race. Because previously, studies mainly have documented the race of loan officers, but not about like bank ownership by itself. So it might be worth delving further into what shapes the effect of bank ownership as opposed to individual agents. One potential way might be to see some network or learning effects amongst the employees within a bank so that the presence of the same race peers or their focused interest on the minority mortgages might enhance learning about the minority borrowers and enhance like information transfer, which can account for this effect of the bank ownership as an organization as opposed to individual. And another thing could be like agglomeration effects. So authors can see the geospatial variations which have been controlled throughout the paper, but also can be relaxed to see whether these effects kicks in. So yeah, it'll be certainly interesting to see organization or spatial network, whether those networks enhance the breadth or the quality of information shared amongst the minority-owned banks. So I think I'm waste out of time. So I will just leave it there, and then I look forward to the next version of the paper. Really enjoyed reading this. Thank you so much.
Okay, we have a few minutes left for questions. Please wait till the microphone gets to you. Yep.
Yeah, thank you so much. Really interesting paper, and I think quite groundbreaking conclusions about the fact that, you know, minority banks are successful at that kind of level. I guess just a broader reflection, and I'd be keen to get your views on this. How far are these positive conclusions? Because effectively we're saying that the banking system is segregated to some extent. Minority banks are successful in that they're exploiting a gap in the market that exists, as opposed to white banks, as you said, which, to be honest, I think is accurate, right? Which is probably why you slipped and said that. So what do we do about that, and kind of your views? Because it could legitimize large firms to effectively offload this portion of their business to banks that are just more equipped to deal with that type of client, which I think is a problem. So I'd be keen to get your views on that.
Hi, let me ask you a provocative question. What about banks that don't have loan officers, but they use AI to gather information and give a sense if you're gonna get the loan or not? Do you have any data on it or any sense of it? Thanks.
Thank you for the paper. I thought it was really interesting. I wanted to follow up on the claim that you made that Asian banks have better information about Asian borrowers. So why do you think that is the case? And I also wanted to ask you about the smaller default rate that you mentioned in the case of Asian banks. So I would like to know if you have studied whether this smaller default rate holds for other ethnic groups such as blacks or Hispanic people, because otherwise it could be, yes, that Asians as a whole have a smaller default rate. So I wanted to know if you have any thoughts on that. Thank you.
Yeah, just I think Seula brought somehow related some of the points in her discussion. I was wondering if you have a sense of how strategic these financial institutions are in, like where they enter or exit the market. So are they seeking out communities with a high proportion of of an Asian population or a black population? Or I think that would be interesting to study.
Thank you. Have you looked at other kind of lending, like small business lending, which is another place where you could see this kind of information effect?
Questions? Go ahead. Why don't you?
Fantastic. Well, thank you so much, Seula, for the very useful and insightful discussion and for the many, many insightful questions. I'll try to address them all. I think I'll go the reverse order too. So small business, yes, we're trying to follow up follow-on work with small business lending. So stay tuned for that. In terms of strategic actions on part of the MDIs, there's a couple of different things I want to say, which is one is that, yes, they're usually located in these sort of communities that are disproportionate of one race, so they definitely do locate themselves strategically. The other aspect of is that that also was brought up in the discussion is to what extent is this lower default rate among Asian borrowers at Asian banks, for example, selection, as in that they're selecting better risk, or are they actually having a treatment effect in terms of helping them repay them and working with them the way you might expect from a community bank. And this sort of disentangling of treatment effect versus selection of the banks on the borrowers, we're really thinking hard about, but we haven't been able to come up with a solution for that, and we'll actually welcome any suggestions for that. In terms of better information, so we do have an anecdote. So we actually spoke with a Latino credit union who said that their target credit Latino population often uses these furniture rental services, and furniture rental companies don't report their payments on the furniture rentals to the credit bureau. So what this Latino credit union does is to actually call the furniture rental company, get the repayment history for the furniture rental, and uses that as one of the inputs into mortgage decisions for their target borrowers. So that's, I think, one anecdote. It's just one anecdote, but it's an example of what kind of an information advantage these more targeted banks might be able to have. And two, in terms of default being lower for minorities, we have results for Asian, Black, and Latino for Hispanic for 2018 and onwards. The Black borrower subpopulation for Black MDIs is too small to actually have a meaningful estimation. Both Asian and Hispanic borrowers seem to have lower default rates than the white borrowers at those institutions. We're currently expanding that data set going back to 1992, so hopefully we'll have more power to answer that question better soon. In terms of AI, I'm really not sure about AI, and I have no expertise to speak to that. But when it comes to automated lending standard, so automated underwriting services, that service does close gaps in approvals for minorities and whites. So there's some hope, I think, for automated services that depend on criteria versus sort of more personal decisions to close the gap. In terms of the very big picture question of what to do, I mean, great question. I think how we hope to contribute to that discussion is hopefully in the follow-on work where we try to really dig into what is it about these MDIs that make them better close the gap in lending between minority and white borrowers. And if we identify the factors that contribute to that, and already we're sort of getting to that organizational factor somewhat, maybe other banks can also replicate that so that they too can be making more equitable mortgage decisions. And now to get to discussions, and I'm sorry I'm losing so much time. In terms of the organizational factors, we've already identified a few. So one is actual mandate. So some of these MDIs are actual CDFIs who actually have a mandate to lend to certain target populations. So for them, their incentive contracts are actually partly based on how many of the target population they serve. So for certain MDIs, for example, if they make more loans to Black borrowers, they are actually compensated better, those loan officers. So that's one aspect, is the incentive contracts. Second is we are seeing that there's a segmentation of the labor market between loan officers that work at MDIs versus loan officers that work at regular banks. So it seems that they're attracting a certain type of talent that may be sort of better at sort of not being swayed by racial bias, for example, when they're making these loan decisions. But we're really trying to dig into these factors, trying to see which one contributes how much. A couple other responses. So credit cost. So we have a PMP that shows that credit cost gap is actually not there. So it's all works on the quantity rationing margin and not on the price margin. And then you read our mind. We're sort of trying to expand everything to a different diff analysis so we can look at the actual racial discrimination question as well. Thank you so much again. We'll definitely reflect all these insights.